On a not so serious note, just as this thumbnail appears, the picture in the current stock market is nothing less than confusing. So let me add to that confusion. But after that, I'll do my best to make things clear once again. So let's take a look. So to add to your confusion, this is a technical chart I came across today. And I'm going to give you a brief, very abbreviated description of the chart that came along with it. And actually, I'm going to skip through about 2/3 to 3/4 of the description because it's so confusing. But let me jump into the end, which is essentially a bullish scenario or a bearish scenario. So let me read to you as follows. A sustained move over 26,358 will indicate the buying is getting stronger. If this move creates enough upside momentum, then look for the rally to possibly extend into the 50% level at 26,508, followed by the Fibonacci level at 26,697. Look for sellers on a test of 26,508 to 26,697. And then the bearish scenario is a sustained move under 26,325 will indicate the buying is drying up or the selling pressure is increasing. This could trigger a pullback into the main 50% level at 26,163. This is a potential trigger point for an acceleration to the downside with the next target, the main Fibonacci level at 25,892. So you got that? And again, that's an abbreviation. Well, don't worry. You can forget it all because as whoever wrote this probably doesn't have a clue. So let's go to our charts. So now looking at the 20-year monthly chart on the spiders, the SPY, hopefully we can give you some clarity here. The close on Friday was 294.35. Now, on Monday, I have a video coming out that discusses the fact that many investors believe that a sideways trading market is an indication that the top in the market has been set. Now, the spiders haven't been necessarily moving sideways. You can see they've been moving in a trend, upward trend, with the bottom there consistent with the 20 EMA and the upper line of that channel moving on up like that. But other indices have been moving sideways, and they point to that saying that perhaps that is a sign that the market has topped. Well, I disagree with that. So let's go through that here. Looking at the MAC, the current formation here looks very similar to the current or the formation back in 2015, 2016. We've talked about that a number of times, and it still looks very similar. The fast line has been moving consistent with the slow line for the last couple, 3, 4 months, hasn't broken above or below. It is possible, given recent trading, that the fast line may break back down here again. But as long as it stays within reach, hopefully above that 10 level, doesn't have to stay above that 10 level, but hopefully within reach of the slow line, we're in great shape. And I think that's what's going to happen. So even if it comes down, it's going to gather strength and move back over that slow line, and hopefully the market will be on its way. Now, looking at the histogram, you can see pretty much the same thing there. We're moving on up, and then we're wrestling with that zero line for the last couple, 3 months or so. Into the price rate of change, you can see that it's attempting a bottom or a basing in this area here, still above that zero line, not unlike this time frame there. Moving down to the RSI, we're at a moderate 58.77, and it's got some congestion above that 50 or midline, and that's what we want. That's fine. While the market gathers its strength for another move upward. Looking at the stochastics, the fast line looks like it wants to roll over here, but that's possible. But it isn't necessarily significantly negative because we're still in that overbought territory between 80 and 100. So for it to lose some steam, come back down here and give another attempt, it's not a real big deal. I don't see any real problems, any red flags with that at least not yet. Moving into volume, that's not going to tell us too much. And then into the Williams, similar to the stochastics, we're up in this overbought territory between 0 and -20. And so it's possible that it can have a move down below, such as it did here. But as long as it moves back up, then we're going to be fine. Back on up here to the MAC. Again, I'm thinking that there's a little bit of divergence here, just like there was back in 2016. The divergence being that perhaps the MAC is trading sideways within this sort of channel here, but at the same time, the price has been moving up. And in my opinion, on this formation, the MAC's going to win out in the sense that it may come down, collect its strength, and move up through. But I think ultimately it's going to move up through. And that means that the market's going to rock and roll. So that window of opportunity that I told you opened a couple of months ago, that window of opportunity is going to be closing, I would say within the next few months or so, certainly by the end of the year. So continue to be prudent, make good choices, good selections in your stocks, watch the fundamentals, but as well understand that, in my humble opinion, the window of opportunity is going to be closing relatively soon. So for today, that's ChewDog Charts. Thank you.